So the Feds hold steady on rates. What does that mean? Really important information that we're going to dive into real quick, but please reach out if you want more information. The Feds held a meeting and they said that they're going to hold the Fed fund rate steady. So they expect 3 more rate cuts in 2024. So what that means is they were anticipating before increasing the Fed fund rate potentially this next year. And now they're saying, no, wait, it looks like we have inflation under control. So we actually are expecting that we're probably going to cut the Fed fund rate in 2024 3 times. So this is huge news. This is big news. And the reason why is that means that the Feds believe that inflation is starting to become under control or is under control and are now just going to keep it at pace. So what that means is that the number one focus of the Feds to lower inflation has an impact to mortgage interest rates, which is why I'm jumping on this video for you. Every single time that inflation has come down, mortgage interest rates come down with it. So this is a good indicator of where mortgage interest rates will be going as we head into 2024. So those of you that have been waiting for interest rates to come down, it does look like we're starting to head into that territory. What does that mean? As you can see, this is what's known as mortgage-backed securities. This is what tracks what's going on in live time with mortgage interest rates, if you will. These are called candlesticks, and this is back from September down to December. And then when we're up here on the chart, it means it's lower rates. And then when we're down here, it's higher interest rates for you as the consumer. So you can see we've had a roller coaster. We've had rates up here where we were low, went high in October, and now we've recovered quite a bit better than we were in September. So great news, as we had just discussed, with interest rates, that means investors also believe that yes, inflation is coming down. The Feds are on board. They agree. Everybody at the higher end is saying that everything points to inflation coming down, which is better for mortgage interest rates. So as you can see here, we've seen some recovery today, which is great news, meaning interest rates have come a little bit lower. Now, the reason that we want to talk about this is we're looking at all the top people, all the main bank rate, FHA, FA, all of the people that are the high level that are tracking this. So this is not me telling you, this is the high level that we're looking at specifically at the stats and the data here. So bank rate here, we're seeing that they said, yes, the Fed's increasing the Fed fund rate and expecting some cuts this year is going to have an impact because many Americans may jump at the opportunity to buy because interest rates are going down. But now this is even more upward pressure on home prices. Now, as we know, inventory, which is how much is on the market right now to even be purchased, how many people are selling or new home sales, is super, super low. And when we have low inventory and you have high demand, makes prices go up, right? Supply and demand. So as you're looking at this, they also agree that while interest rates are coming down, it's going to now have more pressure on home prices going up. So there's this window that we're in. And if you look at all the statistics, all the history, look at, economics in general, when we see interest rates come down, it means it's more affordable. And for every 1% lower in interest rate, now you have over 3 million buyers in the market. Well, if we have 3 more million buyers in the market right now because interest rates have come down, that means now there's more offer on each home. That means now that they're offering more on that home, which means prices are going up. So we're in this window where it hasn't yet caught up to where home prices have shot up quite a bit. But while we're in this window, it's really important for you to look at the data because as interest rates continue to come down, there's more buyer on the market. We have low inventory. You're going to see that that's going to start turning to where we're going to have a big increase in home prices going up because people putting in offers. Now, if you followed the market back when interest rates were really low, it was we had that huge impact to the point that when interest rates were low and there's multiple buyers, now you had people releasing what's called contingencies, buyer risk. You couldn't sell and buy a home at the same time, which is called a contingent offer because sellers weren't accepting your offer if you had any of those contingencies. It was not a great market for people looking to sell and buy, and it was not a great market for buyers in general because you're having to offer more for the home and you would also not have as much credits or negotiations. So we're still in a window where there's negotiations. If you are a first-time home buyer who needs credits, if you are selling and buying, if you are anything that's standard, then you have a lot of money to put down and you can wait to buy. You definitely want to take advantage of this pocket in the market that we're in. And although if you look at interest rates where they are, as they continue to decline, sure, you can get a lower rate. You're going to pay more for the home, which is going to cost you more over time. So that's why I'm showing you this data is it's really important to understand what's going on. Every year, they reevaluate. You can see here FHFA. This is their stats and their Q&A. You go look in their website, shows how they come up with the new what's called conforming loan limits. Now, this is important because it's an indicator of what happened with values and where we're going with values. So the FHFA came in and said at the end of this year, they reevaluated it, and based on where values were and based on where the values are going, they increased our loan amount. So we were at 726, now we're at 766,551 here in California. You can see there's different areas for those amounts. Why is that important? If you were somebody who felt like the values were going to go down, this shows you that they found that values went up and they expect that they're going to continue to go up as we move forward. As we discussed with interest rates going down, more buyers in the market also is going to make home values go up. So interest rates, yes, are coming down. Values, yes, everybody says that they agree that those are going to continue to go up. And then this shows you a home price index. Now, if we look back in, the 1970s all the way until today, you could see what home values have done, where they have gone, where they're going. Now, I want you to look at this because, again, we look at all the data to get all the indicators. Life is about patterns, and that's exactly how it works with economics as well. So if we look at this, which this comes from Fred, so these are all actual graphs, economic data. This is not my data. You can go and look at all this economic research yourself. You could pull these data stats here. But what I want to show you on this specific one is this is the house price index. So on here, what you want to look at is from the 70s till today, what has happened with home prices? Well, you could see that we have gradually gone up. Of course, we all know what happened in 2008. Housing prices peaked. And then because they were bad mortgages where they were adjustable rate mortgages, they overbuilt, had too much inventory. They had appraisers that were just giving values. There were stated incomes. It really put people in a position that they couldn't afford the mortgages. And when those adjustable rate mortgages adjusted and they couldn't afford the payment anymore, we all know what happened. So of course, home values came down. But here's what I want you to look at. If you look back from the 1970s, you can see here, there's never been a period where even 10 years that home prices have not recovered. So even if people believe that, yes, home prices are going up right now, but I think that it can't sustain that and home prices are coming down, never in the history have they not recovered within that 10-year period. So unless you're looking to purchase a home for a short-term benefit, which we can argue that, we'll see that home prices will continue for a while because we're not going to have inventory, even if they were to crash. You could see here that even in the history, we've never had a 10-year cycle where you didn't recover in your value. If you're in a 30-year fixed rate mortgage, you can afford your payment, you're going to be in a great position. Now, here is the 30-year fixed rate mortgage data. So again, pulling the graph. Why I pulled this one is I think it's important for you to see where interest rates have gone. We're so used to where it was when the interest rates were at the bottom, but look back here, back into the 1980s, you could see here that this back to 1978. So we could see here the interest rates were higher. They went to their peak, they've come down, and then you can see they went down and they've gone back up. But look at where rates are. So even if we take where rates are today, it's actually pretty average to where rates are over time. We were just very fortunate to have low rates. So people think, well, we can't sustain the higher rates. We can't sustain the higher value. We're kind of softening and going back to average to where interest rates were. Do we come back down? Yeah, we already showed that, with inflation coming down, that we're going to see mortgage interest rates come back down. Do I think they're going to hit a 3%? I don't, but I don't have a crystal ball. I think that we'll soften at a pretty good level with where interest rates are going to be and level off from there. But why I think this is really important is if you go back and look at the home price index here, you can see that here in 2008, right, home prices were higher. If we go back and look at the graph here, you can see what happened with interest rates. There wasn't really a lot of movement when they were up and down, but you can see here kind of gradually they came down afterwards, right? They followed this, they came down. And then you can see where interest rates have kind of stayed stable. And then of course we saw them come down during COVID, and then they've gone back up. So everything follows graphs and stats. And I think it's really important to look at the information. And just like they're saying on Housing this is great news for interest rates coming down for people to be able to buy. But you got to be very cautious and understand what that means on the other side and where we're heading to make a smart, educated decision. If you have been looking to buy for this last year, you have been maybe waiting because you thought, well, I'm going to wait until rates come down, or I'm going to wait until the values come down. Well, we have found that interest rates are coming down, but now housing prices, when interest rates come down and when we're recessionary, it means that housing stays stable or increases more demand. So the housing prices are going up. It's really important that you meet with a mortgage advisor such as myself, where we're going to look at all of the information and see what makes sense for you. Some people, it may not make sense for you to buy, and we'll look at your plan moving forward to make sure how you're prepared. If you're thinking about selling and buying, you may have a 3% interest rate that you don't want to let go. But if you know in the next 5 years that you need to move, whether you need to expand your family, move locations, school districts, combine families, anything that you know in the next 5 years where you're like, we're going to have to make a move, but I'm just waiting for rates to drop. Remember, as interest rates come down, there's more buyers on the market. If you have to sell in order to buy, that's a contingent sell. You're not going to have a seller want to accept your offer when they have multiple offers that have no contingencies like that. So it's very difficult in those markets. And then we have to look at creative financing to where maybe you can take money from the current home to be able to buy the other home. And it's very expensive. It costs you more than if you were to sell and buy in today's market where you have more opportunity to have a seller accept your offer than to wait. So make sure you have all the data. Let's talk about your specific situation. Let's look at the DATs and the SATA from a standpoint of factual information and patterns that we're looking at, not just somebody saying, you should buy today. That's not how I roll. I want to make sure that you understand all the data, graphs, information, and I'm happy to go over all of this with you. I follow this every single morning. I'm researching all the data. I'm looking at it from both sides and seeing what makes sense, what doesn't make sense, so that I can make sure to educate you on your information and your specific scenario and whether it makes sense for you. So give me a call. Let's look and see if now is the time for you to buy. I would hate for you to wait and it costs you so much more money because you didn't have the right information and you thought that higher rates or higher payments meant that it's going to cost you more when in reality, it didn't.